Hi, I'm Vanessa from the distribution team at Capital Group, and here with me today is Andrew Lee, our Investment Director for the Capital Group New Perspective strategy. Today, we will be discussing why we think now is the time to take cash off the sidelines and to reconsider entering the equity markets. Hi Andrew, good to have you with us here today. Let me just kick off with the first question. Okay, so with the probability of further Fed rate hikes becoming less likely in the next 12 months, do you think we are at a turning point right now and is now a good time for investors to start deploying their cash into the equity market, or do you think they should just wait for the Fed to cut rates before, investing in global equities?
I think it is a good time for investors to move back into equities instead of adopting a wait-and-see approach or act only if and when the Fed started to cut rates. But before going into the reason why, I think it would also be helpful for us to take a step back and to understand why some investors would prefer to wait. And I think it's largely driven by what has happened last year when inflation in the US has surged to above 9% at some point last year, while at the same time, interest rate had gone up significantly within a very short period of time to tame that inflation. While thirdly, if we look at global economies, growth was struggling due to a number of factors that include supply chain bottlenecks, as well as the Russian-Ukraine war. And at the same time, what happened last year was that cash and fixed income fell in tandem, and that resulted in some investors shifting their assets into cash and cash equivalent instruments. Also, given the fact that cash, for the first time in many years, have started to offer reasonable returns. With that being said, going into this year and at this point in time, I would argue that a lot of these factors have no longer been that scary. Well, first of all, inflation have come down to more normalized levels. There are increasing market expectation that interest rate could see peaking and towards the end of this year, and also potentially some rate cuts going into next year. And finally, global growth, especially in developed markets, have defied gravity and turned out to be way more resilient than previously expected. And if interest rate has indeed peaked, then I think it really presents a very compelling time for investors to get back into equities. Because if we look at the previous four Fed rate hike cycle, average return of global equities 12 months after the last US Federal Reserve rate hike was about 12%, which was a pretty good level of returns, especially when we compared that to the 4% for cash. But last but not least, we also have to acknowledge the fact that central banks officials have been deliberately cautious when communicating messages around the future path of interest rate. And we remain to be under a relatively uncertain macroeconomic environment. But that being said, there are increasing signs that we're at the turning point in interest rate, which would pivot more opportunities towards equity investment going forward.
Thank you. So since the start of the year, global equities have risen around 15% at its peak. So can you share with us what has driven this strong rally, and is it too late for investors to enter the global equity market at this point of time?
Well, I think if we look at this year so far, most of the returns of the global equity market can be attributed to just a handful of companies. Well, essentially the so-called Magnificent Seven. So they are Tesla, NVIDIA, Amazon, Apple, Alphabet, Meta, and Microsoft. And they have contributed more than 50% of total return alone. But if we look beneath the surface, most of these gains that we've seen were primarily driven by re-rating rather than really strong earnings growth. And while the outlook for these companies may continue to be very strong in the future, I think that there are actually abundant investment opportunities across different sectors. And in other areas, such as the more underloved areas of the market where we saw these companies are continuing to trade at reasonable valuations, share price haven't really gone up to the same level as the Magnificent Seven, while at the same time still well positioned to benefit from long-term secular trends such as healthcare innovation, as well as infrastructure supercycle. But then if I can also add to your question, I also realize that some investors are currently waiting for a recession to happen before getting back into the equity markets. So essentially they're asking themselves, okay, when will a recession actually happen? Well, I think increasingly this is not the right question to ask because this conventional binary outlook for the markets failed to really acknowledge the fact that COVID, as well as the Russian-Ukraine war, were massive destructive events that has caused a desynchronization in global economies. And as a result of that, what we're seeing is a rolling recessionary scenario. So what does that mean? Well, it means that some of the sectors have actually gone through their own recession and have since been embarking on a recovery trajectory. So for instance, if we look at travel, it's a really good example. It endured a really painful recession during the COVID period, but has since then been recovering. Semiconductor had a pretty strong inventory correction last year. And again, going into this year, we're starting to see the bounce back within this sector. And then also finally, if we look at some of the other sectors such as housing, well, it was hit pretty hard because interest rate went up significantly higher within a short period of time, but also going into this year, we're starting to see recovery from there. But then if we look at the other end of the spectrum, then we have sectors that, such as certain elements of the manufacturing sector that are just going through their own recession. So I think putting two and two together, it's not too late for investors to move back into equities. And actually, it's a good timing for them to do that. But the key here is to be really selective and focus on companies that have a good outlook from here.
All right, thank you, Andrew. And where are you seeing opportunities in the New Perspective strategy right now?
Sure. Well, New Perspective, it's a core, flexible, all-weather global equity strategy. It's a well-diversified portfolio that aims at looking for global champions for today and tomorrow. Have been doing that quite successfully over the last 50 years and continues to be well-positioned to capture these vast spectrum of opportunities in the next market cycles. So from a bottom-up perspective, I would definitely highlight healthcare because we are clearly in the golden era of healthcare innovation. If we look at the number of drugs approved by the US FDA annually over the last few years, it has increased almost 70% compared to a decade ago. And we are also seeing really big breakthroughs in drug development from across different areas, from targeting critical diseases such as cancer, as well as cystic fibrosis, all the way to GLP-1 drugs, which is addressing the issues of obesity. And in fact, if we think about there could be the potential of seeing almost 18% of the world's adult population having the conditions of obesity. These drugs definitely have a very strong potential to be one of the biggest drugs in history. And then the other area that we'll point out would be industrials, where we're finding a lot of great opportunities. And in fact, we think that industrial as a sector that it's in the early stage of a glorious renaissance. It's really because if we look at globally, governments are really making big fiscal commitments to improve different infrastructure areas. If we look at the United States, the government has committed around $1.5 trillion in improving their infrastructure build-out. And that means that the capital expenditure would probably go from currently 7% of their GDP, which is the lowest point in recent decades, to about 10% of GDP. And who's going to benefit from this? We think that one areas would definitely be companies that are driving the energy transition. And an area that we're finding particularly conviction in is heating, ventilation, and air conditioning. Why is that? Well, we think that it's largely because buildings account for about 40% of greenhouse gas emissions. And within that, 40% to 50% is actually from heating, ventilation, and air conditioning. So some of the leading companies are really putting a lot of investment, especially on the tech side, in order to make them more efficient. And industrials, conventionally, it's interpreted as more old economy sectors, but what we're seeing is that there are a lot of structural growth element in it, and a lot of the companies within the sectors will benefit from long-term secular trends. And then last but not least, it will be digital disruption that's getting a really strong lift, especially going into this year by AI. It's an area that from an investment standpoint, we've been looking at for many years, and finally we're seeing AI going to mainstream and really accelerating the AI development and adoption and commercialization. How do we approach this from an investment angle? I would think of it as a four-layer framework. First of it, it's the compute. So AI requires a large data set, and data set basically requires a lot of computational power. Semiconductors being a big driver of this, It's, as a result of that, also a big investment that we have within the portfolio. And then the second layer would be infrastructure. So these large data set will definitely need a home to stay, but also a home for them to communicate and also be managed efficiently. So the cloud computing hyperscalers is definitely an area of focus in this layer. And then the third layer would be the applications. So what we're seeing are essentially software companies and developers. And from an investment standpoint, what we're focusing on are essentially the large platform companies for given their really strong advantages, such as large set of proprietary data, as well as just a very well-established client base where they can push their AI products and achieve that direct commercialization. And then finally, the fourth layer is beneficiaries. Right now, we're seeing AI adoption in some of the industries such as healthcare and financials, where companies are using AI not just to improve their products and services, but also improve their efficiency and productivity. And we think that from an investment standpoint and over the longer term, the investment opportunities are just going to be limitless.
All right, so there's 3 areas for us to be excited about: healthcare, industrials, and artificial intelligence. Thank you, Andrew. That's all the time we have for today. For more information on a new perspective fund or additional investment insights, please feel free to visit our website at capitalgroup.com or the various iFAST platforms. I hope to see you again soon.